The Wall Street posts minor gains this week, ending higher for the second week in a row. Pharma, metals back for the bulls, but FMCG takes it on the chin. Well, on today's edition of Editors Roundtable, we'll take stock of the week's market action. We'll decode RBI's monetary policy and its market impact. And we'll tell you why QSR firms are making a comeback. I'm Reema. With me are Surbi, Naichan and Mangalam. Hi. Hi, guys.
Hi, folks. Thank God it's Friday.
And you can finally say that because we couldn't say it last Friday. But let's also welcome on the show Ramesh Mantri, CIO, White Oak Capital AMC. Ramesh, hi.
Hi.
Well, what a week this has been, right? It's been extremely long. There was Saturday, and that Sunday felt like it was nothing. It was just...
Thanks to Donald Trump and the tariff news and the earnings.
To come back, and then so many earnings. I think about 15 or 16 Nifty companies reported their earnings this week.
And across all sectors.
I think the biggest debate this week has been about the Indian consumer. And I think Mangalam's going to talk about this, whether there's a slowdown, no slowdown, has the budget addressed it or not, has the RBI addressed it or not. I think that was a central focus.
I don't know whether who's addressed it or not. What I'll talk about is something a lot more delicious than just the consumer. It'll be specifically quick service restaurants, but the market.
Yeah, so let's take stock first of the market. You know, one positive that I've learned in life is if there is a problem, you need to address it. And I think that's precisely what the government of India as well as RBI have done. The government of India in Budget 2025, they have given that consumption boost. So the economy was in need of something and they've given that, point number one. Point number two is that, in fact, in the RBI, they were bracing for a 25 basis rate cut. And that's precisely what's happened. And in addition to that, they also had done those various liquidity measures. So both those two, they have addressed a problem out here. Next up, the bulls, I believe that in the near term, it appears that 22,800 odd mark, they believe that should get protected, which was the panic low that we saw closer on 7 to 8 trading sessions ago. The uncertainty really is going to be on Trump's tariffs, right? What is he going to do next? For the time being, the global markets, they believe that he's going to use it as a negotiating tool. Nothing big is going to happen, but it's going to be a negotiating tool. At least that's what, the indications are. If you look at the dollar index, if you look at the way the global markets panned out as well, there's going to be uncertainty as well from the Fed as well as the Bank of Japan. What those two big central bankers are going to do, which will have repercussions for the global markets as well. And that's going to be important. The FIs were pleasant surprise this week. After a while, after 23 sessions, they went ahead and they bought at least one out of one, but that's okay. At least one out of, and if you take the cumulative number for the week, it's much lower than the previous weeks on an average. So I'll take that as a positive as well. But a few stocks I just want to talk about, and there's no room for error on stocks that are trading at elevated multiples. Trent, the numbers didn't look that bad, but the stock got clobbered. For the week, in fact, it was down closer around 11% or thereabouts. Some of those stocks that have underperformed, suddenly they've started performing. If you look at Bajaj Finance, right, that didn't do much for the last few years. In this year itself, it's up closer around 8 to 10%. And in fact, in this week, it was up closer around 5%. IndusInd Bank as well. Big underperformer, maybe valuations are pretty okay. So that one as well was higher. And there's no room for these high flyers. Mangalam, you have Easy Trip, the one that, the big story that was playing out. Swiggy, from it listed, it went all the way to 600. Today, it's below the IPO price as well. So there's no room for error. I think in the near term, there is, we're in that broad band of 23,200 on the downside to around 24,000, which incidentally is the 20 as well as the 200 DMA. So, the markets saw a good recovery this week and we ended more or less flattish. Let's get in Ramesh Mantri and let's see how he's feeling. Hi, Ramesh. Good to see you on the show. What are you making of market setup right now? You have support coming in from the RBI as well as from the government of India. How are you feeling right now?
No, I think we've clearly seen a slowdown in the economy, in the earnings, and you have now two levels of support both on what's happening to the consumers and the RBI. So, and also you want to see now the capex that has not been spent this year, the orders that are not coming, need also to come in. So you need economic pickup, and I think some measures have been taken clearly in the last week to support the economy.
All right, so that's about the budget. But, after the budget, this Friday, we had the RBI policy as well. The street was hoping for a 25 basis points rate cut. That's exactly what came by. What do you made of that?
The street was still not happy enough, right? They wanted a tax cut, they got it. They wanted a rate cut, they got it. But the market's still kind of ambling along. So what does it tell us? I mean, on the RBI policy, I kind of listed out actually 6, positives, which were there, but the market was still not happy enough. And I think largely because it was a ye dil mange more kind of a policy. You've got 25 basis points, but there was no immediate hint of further policy action. There was no sort of, barrage of dovish commentary that's telling you next cut is sure shot on its way, or, that there is a big liquidity bonanza that the RBI is handing out. However, here are the positives, and we should not lose sight of that. Number one, the fact that the decision was unanimous. So there's no discrepancy between the MPC members. All 6 voted in favor of a rate cut. Number two, the governor is pointing sufficient liquidity support to the market as and when needed. Number three, look at the inflation projections. For FY26, CPI inflation is projected at about 4.2%, which is so much better than 4.8. That's the revised estimate for FY25. Number four, the GDP forecast at 6.7%, which is towards the higher end of the forecast that we had from the, from the economic survey, which the upper end of that band was 6.8%. So GDP forecast for FY26 not too bad. And last but not the least, the market's been very nervous about a couple of these regulatory changes that have been pending. LCR guidelines and, of course, implementation of ECL norms, project financing. What did the governor say? In clear terms, he said that all of this cannot be implemented in a rush. In fact, on LCR, he's made it very clear that it's not coming in till FY27, 31st of March 2026. It's not happening before that. And similarly, the others are more, a consultation process right now, which is the ECL norms. And again, that seems to be off for at least another 1 whole year. Yet the market was not pleased. Why? And now I come to the so-called negatives, and negatives in quotes. What do I mean by that? The stance, number one, is still neutral. So if people expected a shift to accommodative, that didn't happen today, and there was no hint of that. And largely, from a stock market point of view, the immediate trigger, look at what the governor and the deputy governor have said on unsecured lendings and also risk weight to NBFCs. Remember, a lot of these stringent norms came in a couple of quarters back to sort of regulate the lending happening in the unsecured place. I just want to highlight these 2 quotes. What did the RBI governor say? The RBI governor went on to say that we're satisfied with the slowdown in unsecured loan growth as of now. The DG, Mr. Swaminathan, he said that we don't think there is any reason to review any measures on unsecured loans at this point in time. Doesn't get clearer than that. And even on NBFC lending, remember the risk weights had gone up. The loans that banks are giving to NBFCs. Is the RBI going to change that so quickly? I don't think so. If you go by the commentary, look at the RBI governor's statement, and I quote, "We've raised risk weights for bank lending to NBFCs due to concentration risks." So he's going into the reasons and why he still thinks, that was a valid move. So I guess this was a bit of the disappointment that played out. But let me take this to Ramesh. Ramesh, at times the market can be a little nearsighted, short-sighted. How would you classify the policy and your take on financial stocks from here on?
First, interest rate movements, there are no correlation with markets. What matters is significant surprises. This is policies as per expectations. So expectations generally don't impact markets. What is broadly expected? I think the deferment of some of the tightening and regulatory measures is a good thing. You need to support the economy now. And I think particularly the steps that RBI had taken on unsecured lending, I would say they were pretty visionary. They looked like conservative a year ago, but they have made sure that the risks in the financial systems has been contained. So I think in some ways, RBI has been an extremely prudent regulator, unlike a lot of other central banks. So I think all credit to RBI for that.
Okay. Ramesh, hi. So Trend was the top Nifty loser today. It rebounded on Friday, but still ending the week down close to about 11-odd%. So it's a part of your fund, your flexi cap fund, a part of your mid cap fund, etc. What is your thought on these, companies which were considered sexy till like just a few months back, but now have seen some growth deceleration? Numbers are fine, 35% top line growth, but it's just slower than what the market was used to in the prior quarters. What is your approach to these stocks?
Yeah, see, first of all, when these kind of stocks, expectations are a treadmill, right? So if you miss a little bit of expectation, there is often violent reaction, both on the upside and downside, right? And here, let's understand there is a slowdown in the economy. And, in India, 35% growth when growth is difficult to find is still extraordinary. In fact, an absolutely outlier in the consumer space in India. So we can focus on what the market did in the last week. But I think the growth that some of these companies are delivering is still very stellar, right? And in fact, very rare in this Indian consumer space in India.
Right. Speaking about consumption itself, Ramesh, you do have Zomato in your portfolio. It's a left field question because it's a left field development. they've named their company Eternal. What do you make of that? And, what do you make of Swiggy's numbers? Do you think that there is a valuation discount play here?
Now, first, the rebranding, I think they want to grow beyond the Zomato brand, which is one of their offerings. They believe the company is bigger than one of their offerings, which was, of course, their core offering where they started. So I think it's thoughtful to rebrand it because now Zomato is much more than the food delivery business it is. I would not commit specifically on any company's results, but I think the quick commerce is a uniquely Indian retail solution. It is going to be very large. And because the total addressable market is large in India, everybody is jumping into this. So it's going to be a difficult 2025 for the space. It is going to be heightened competition in the space. There is going to be red in P&Ls. This is assured in 2025. But because the market opportunity is large, still the ultimate winners will create a lot of value. So we have to stay focused on companies that are executing well. The numbers, the P&L is going to look red in this year for sure. It's going to get reversed actually as we go by.
All right, we take that point. In fact, I'll take a cue from that itself because, we've been talking about out here that over the period of time, burgers were falling out of favor and as were pizzas.
Yeah.
And we had people playing the platform companies. But with a shot in the arm that the government has given for consumption, the question is, where is that extra money going? Could that go to quick service restaurants? Something tells me maybe, because we've seen that in the numbers. So I'll just walk across the wall and tell you that if you look at the government giving 1 lakh crore as a boost to consumption during the budget, and look at quick service restaurants itself, and you look at some of the numbers that have come by so far in the third quarter. We have Westlife, the one who operates McDonald's. Look at this. We've seen the same-store sales growth decline for about 4 quarters until the third quarter, where there was an uptick that we saw. Similar is the case for Sapphire Foods, which operates KFC and Pizza Hut. So you look at Sapphire Foods, you'll have KFC as well, which is reporting a negative like-for-like growth, but it has shown an improvement in the third quarter. You look at Burger King, which is listed under Restaurant Brands Asia. There was decline, and then there is some improvement. This decline was obviously on a high base. The improvement comes on a higher base as well. Earlier, we were talking about pizzas versus burgers. Looks like pizzas are making a big comeback as well. From Sapphire Foods itself, we saw Pizza Hut. Pizza Hut, was reporting negative same-store sales growth. It's been on an uptrend, and this quarter, it turned positive 5%. Domino's, the leader out there, for the longest time, it was negative or feeble numbers. This quarter, it's actually reported a 12.5% like-for-like growth in its pre-quarter update itself. And all of this, tie that down with Zomato. Earlier, the narrative was that maybe platform companies are growing faster than quick service restaurants. Actually not. Platform companies have seen their gross order value decline. Zomato's gross order value in the food delivery business, growth was 16.8%, much lower than we've seen earlier in the past itself. So let's address what the problems were earlier and what the trend is now. The problems earlier for quick service restaurants was normalization after the post-COVID boom. Secondly, there was structural decline in dine-in revenue. People weren't going into these restaurants. Then there was competition coming in from the aggregator apps, competition from local chains itself, Lapinos, etc. Many people springing up, and stocks had run up, and valuations had surged to record highs as well. Now, after the underperformance, what has changed? Inflation has shifted urban consumption towards affordable treats. Companies have increased their value offers on dine-in, so that has arrested the same-store sales decline that we're seeing in dine-in. The companies have also rationalized their stores from earlier dine-in to now delivery only. Add to that, new store additions are happening not only in metros, but they're happening in towns beyond Tier 2, so that has a lot of latent demand itself. Companies have their own delivery fleet. Jubilant FoodWorks always had that. McDonald's has added that as well. That waves off delivery charges. And then everyone's been talking about high markups on platforms like Zomato and Swiggy. All of them have innovated on menu launches. There's McSpicy Chicken, McSpicy Paneer, Cheese Volcano Pizzas, etc. And 80 to 100 local pizza outlets in Ahmedabad have closed in the last 10 months. There are multiple news reports talking about that. So local competition is also abating. And they say you buy these stocks when they're off their highs. Are these stocks off their highs? Yes. Restaurant Brands down about 35% of its highs, 20% down for Devyani. Jubilant FoodWorks itself, after a 62% rally from its lows, is down 14%. what are the analysts saying? Look at what the analysts are saying. On restaurant brands, 50% of them have a buy rating. Sapphire Foods, 8 out of 10 analysts have a buy rating. Devyani, 69% have a buy rating. Jubilant Foodworks and Westlife, because they've seen a rally already and haven't fallen as much from their highs, not all analysts have a buy rating, but still you have an upside potential basis their consensus prices of anywhere between 10 to 22%. And if these stocks, start to re-rate because of growth uptick coming in the next few quarters, who's to say QSRs may make a big comeback?
Very interesting data, and I must say the pictures look so.
It's whet my appetite completely.
Mangalam, you're hungry.
focus on the numbers,
Anything, Mangalam, whatever you say.
I was taught, ask and you shall receive. So
I
what
have
I did was, whether QSRs come back into fashion or not, I've done my bit. So what we'll do is, just grab a couple of burgers, equal opportunity offenders. So there's pizzas and
amazing.
Now we're talking. Wow, thank you.
I love this.
I'll tell you what, I think what we should do
We
is...
have to take
We
a
need
break
to take
now.
that break right
fries
now.
as well. Yes, what we'll do is, while we munch onto these pizzas, burgers and fries, we'll just take a quick break, come back, we continue our conversation on Editors Roundtable.
Welcome back. You're watching Editors Roundtable. We have with us Ramesh Mantri from White Oak AMC. As you can see, we were just talking about QSRs. We're eating them. We're talking them. Ramesh, unfortunately, we can't share it with you, which is why you need to come. You need to come down to our office so you could be a part of this feast. But tell us, QSRs, are they a part of your portfolio? Is it time to look at it more aggressively if you already own it, or if you were shunning it so far because of the kind of weakness in the numbers? Are you going to take a look at it?
So one, QSR is a large structural opportunity in India. But in India, this is not so structural. It is cyclical within a secular opportunity. And I believe because of the advent of these large food delivery platforms in India, a good portion of value has shifted from QSR or restaurants to actually these platforms. So I would say the better way to participate, at least that's our view, is through the food delivery platforms rather than investing directly in some of these QSR chains.
But Ramesh, I want to kind of zoom out to a larger question, going back to that Trent example, or for that matter, staple stocks. My question is very, very simple. For stocks that have traditionally traded at really high multiples because you're getting better growth, and Trent was a classic example of that, right? You can go up to 80 times forward earnings, 100 times forward earnings, but you're getting that kind of compounding growth. Similar could be applied to the EMS space as well. But now, given the market environment that we are in, which are the kind of companies or the sectors or the stories for which you would still be comfortable paying, maybe 70, 80, 90 times, if at all?
So clearly you want to see first very large markets, whether it's, food delivery, branded apparel, a variety of sectors on the consumer side. Number two, you want to invest in market leaders, clearly people who already demonstrated the track record of execution. That's the kind of multiple that's only, you can pay only for a market leader or someone who is significantly gaining market share. And please understand, in 2021, 22, 23, actually broad-based economic growth came back in India after many years. Now in the last 6-7 months, growth has again become scarce. When growth becomes scarce, actually growth stocks become more valuable.
All right. Ramesh, just before we let you go, in the result season so far and the environment that we are in right now, what is it that you like? The couple of ideas which you believe that, are worth holding on to even in this environment, and perhaps stuff that will make you money over the next couple of years?
I think this is a time to go back to more quality businesses, more sustainable businesses. So I would say, I think financial services continues to deliver very stable performance. There are still no broad-based credit quality issues. Valuations are very reasonable. So I would say frontline banks, even within that, if you look at NBFC, maybe affordable housing, where growth is still very strong, valuations are reasonable. And then also look at some very high growth opportunities, let's say in the digital transformation space, where India has still started the journey. Those are the attractive spaces. I'm always a perennial bull on pharma and healthcare because I believe it's a sector that's more stable than even consumer staples. People never cut back on pharma or healthcare consumption. So these are the spaces that I find very interesting today.
Okay. All right, Ramesh, that's really helpful advice. Thank you so much for joining us on the show today.
Nigel is still eating.
And
He said pharma and health. The minute he said pharma and health, the people I was
Nigel, last word from you.
The consumption story is strong.
You asked him for the last word, he'd be like, oh, I can't do it.
And
Lucky.
Thank you, Manglam, for making it
Manglam made it
very
very
exciting
special.
editors round. You should come more often on here. All right, folks. It's a wrap.
Imagine if he does a story on trend.
We're good
What
with
will we
food.
get?
We're good with food.
It's a wrap. Nigel,
I
let's-
think
Well,
I think it's time to go.
On that note, I'll tell you guys, we'll wrap up on this edition of Editors Roundtable. Thanks a lot for watching. More news and updates on the other side.